Hello everyone, my name is Reese, and in this video I will be talking about what I consider to be some of the best short-term investment options for ways to help grow your cash rather than leaving it sitting in a checking account with almost no interest rate. And specifically, when I'm talking about short-term investment options, I'm talking about you're not saving. These aren't going to be methods to help grow a portfolio for retirement. They're not going to help you see, exponential growth that you might see in the long run with some of other investment options, such as investing in the stock market. Instead, these are going to be investment options for when you have a shorter time horizon, such as an emergency savings fund, a savings for a car down payment or a house down payment, something that you have on the upcoming future, and you don't want to risk investing money into like a stock market fund and then watching it potentially crash in value, because even though historically stocks have performed the best returns in the long run, they are very volatile and subject to short-term fluctuations and sell-offs such as what we are seeing right now. And specifically, I will be going over what kind of tools I use as well as what I think might be good depending on what your situation is. So, to start off, the reason why we don't want to hold a significant portion of money in a checking account is because usually those are going to have very low interest rates. I have a Capital One account personally, and I believe my checking account is around 0.1% APY. So, you're really not really getting any interest payments on that. And usually, what I personally do is whenever money comes into my checking account, I use my checking account to pay bills, but I basically just keep it at a certain balance, and then anything exceeding that, I transfer over to a high yield savings account. And high yield savings accounts are great because they're going to usually offer you higher interest rates, and they are going to be liquid. It's easy to move money in and out of it. If any expense comes up, like especially if it's like unexpected car repair, you can easily just pull money out of your savings account if you have that money set aside. Whereas if I was trying to pull money out of a stock market account right now and watching the market being down significantly from the market peak, that's going to hurt a little bit more. So I think everyone should have at least a high yield savings account as an option to keep money in, maybe cash that they don't need, or some sort of emergency fund set up if they're able to start working towards one. Because I think that having a liquid, when I say liquid, I mean it's easy to get that money in and out. You're not going to have to wait for a buyer to potentially buy it or anything like that. You can just go to your app, transfer that money out of the savings account with a click of a button. And I personally use Capital One because I find it to be easy to use, as well as they offer some of the highest rates currently. Now, I'm not saying you have to use Capital One. Any major or pretty much any banking institution is going to offer you some sort of high yield savings account, hopefully, that should have a decent rate. And I'm just showing what I personally use. And as of right now, it's 3% APY. This is subject to change based on interest rates. And currently, with the Federal Reserve just bumping interest rates by another 0.75%, I think that the Capital One and interest rates as a whole for banking institutions should follow. It just might lag a little bit. So let's talk about, that's essentially what I think savings accounts are good for. They're good for money you need, or potentially just having it in a pile stashed for expenses that you might come up. This isn't going to significantly grow your portfolio by any means at 3%. It's just going to be better than holding it in a checking account. Now we're moving towards a little bit longer. So this is good for unexpected, unforeseen, emergency fund type of things. But let's look at what could be better for if you are trying to save up money for like a house down payment, for example, and let's say you have a 5-year time horizon or whatever it is. It's something that's not quite long-term enough to really feel safe about investing in the stock market. On the other hand, we want to try to get higher than what a checking account might offer us. So another popular option is simply a CD account. And what CD accounts are is a certificate of deposit. You are essentially lending a banking institution your funds for an agreed upon time horizon at an agreed upon interest rate. Now, these interest rates will fluctuate, but whatever you agree your interest rate to be at when you open your account, typically that's what it's going to stay at. and they're going to offer CDs for multiple time horizons. And usually, the longer you're holding it, you might get a higher percentage interest rate. And as of right now, Capital One, they're offering a 1-year CD at 4%, and then 5-year at 4.25%. These are going to fluctuate depending on market conditions, and like I said, because the interest rates were just bumped by the Fed, these might be increased as well in the near future. So here's a little bit about pros and cons when it comes to CDs. Typically, CDs are usually they are a lump sum contribution, and you might not be able to make for additional contributions to it. So if you have a pile of money and you want to move it into a higher yield savings type of thing, a CD might be a good option because you're going to dump that money in, but you won't be able to make monthly contributions to it like you would with a high yield savings. Also, it's going to be a little harder to pull money out of these CDs because you are agreeing for a set time horizon. Usually you can withdraw early, but you will pay on average a 3 to 6 month penalty on your interest payments that you have been receiving. So for example, with Capital One, they have a 3-month penalty for if, say, I have a 1-year 1-year CD and I pull out early, I'm going to pay the past 3 months of interest back to them. And it's not really like I'm paying it back. It's simply just deducted from the value of what I put my money in. So if you put your money into a CD and you pull out before the first 3 months, you actually lose money. So it's things to keep in mind that you're putting this money in with a set time horizon, and you really want to be able to stick to that, because if you do have to pull out for whatever reason, you have to pay that 3-month penalty. And these are going to be all or nothing. You basically are throwing in a lump sum at once. You can't make contributions to it, and you can't withdraw only a little bit. You have to withdraw all of it. And that in exchange is you are getting better than average interest rates. So what I'm getting at with these CDs is that they are a good tool for if you have a set time horizon or a time horizon with money that you know you won't need, but you might need in the future. So you're getting above average high yield savings returns. On the other hand, these are not going to be good for if you need like some sort of emergency fund, because if something comes up, it can be a little harder and take a little bit more time to actually get your money out of a CD. So I think that's why it's still good to have a high yield savings account for those unexpected expenses or easy access to your money. Now, there are going to be ways to get higher returns than CDs alone, and that is going into what I call brokerage, or what are called brokerage CDs, as well as the bond market. So bonds are similar to CDs, as you are loaning your money to some sort of agency, company, whatever it is, in exchange for a agreed upon interest rate. And I use TD Ameritrade personally as my personal brokerage, and usually most major brokerages will allow you to go through and see what kind of bonds and CDs are available through their brokerage. Now, I'm not going to go specifically through all the different types, but you will be able to see different bonds, such as corporate bonds, which are going to be your public companies, government agencies, the U.S. Treasuries, and typically you really want, for money that you might need, you really want to make sure they have a good solid credit rating, and usually the higher credibility of the institution, usually a little bit less interest rates that you'll get. But bonds are going to offer you more interest rates on average than what a CD will. So for example, a AA rated corporate is the 7 to 10 year, you can usually get them up to 5.225, and some of the A-rated corporates are 6.1% for 7 to 10 years. With that being said, you actually can filter through and go through it, and usually you can find some higher yielding bonds within that. So for example, I know for the A-rated corporates, there is a company that's paying out right around 7% interest rates. They are a tobacco company, and I'm not going to be referencing them by name, but I'm simply saying, do your homework. Don't just buy whatever high interest bond you are buying if you don't really understand what you are buying. So some of the pros and cons with buying a bond is that, similar to the CD, you're putting your money in for a set upon agreed upon length of time in exchange for agreed upon interest rate. With a bond, though, Unlike a CD, with a bond, you are taking on the risk of the underwriter. So let's say I buy $10,000 of a 5-year bond from ExxonMobil. There is a chance that ExxonMobil will default on that bond and not able to meet my interest payments. In the event that the company that I bought a bond from declares bankruptcy, I actually lose my principal. So whatever I bought that bond for, I lose. Now, that's why it's good to do your homework. Make sure you're investing in high credit companies, and usually the price you're paying for these higher credibilities is going to be lower default rates. Or higher credibility with lower default rates is going to be lower returns. So that's why I really think it's important. I personally am not a fan of high yield corporate bonds, which can have significantly higher interest rates, but they're much higher likelihood of defaulting. So things to keep in mind. Also, bonds are going to be harder to move in and out in. So once you buy a bond, you can only sell the bond if someone else agrees to buy your bond on the secondary market, which is essentially what this TD Ameritrade brokerage is doing, is you are buying and selling indirectly on the secondary market. And also, the thing to keep in mind with bonds is that the values of the bond will fluctuate. So the value that if I pay a certain price for a bond today, there is a good chance that price will not be the same a few months from now or a few years from now. I could actually pull out and lose a significant portion of my investment just because the value of the bonds have dropped. And typically what's going to affect the bond price the most is interest rates. As the interest rates are raised, the value of older bonds is going to decrease. Now, this doesn't really affect you if you hold your bond until maturity. So you're holding your bond until that agreed upon time horizon, you will get your money back, regardless of if the bond had increased or decreased in value, as long as the company doesn't default on the bond. So you basically can kind of just have tunnel vision, ignore, even if your bond value has increased or decreased, you can kind of just hold it until maturity, take your bond payments, and go home. You're a winner. So it's something to keep in mind. It's a risk associated with these bonds is you don't want to have to pull out early and then lose a portion of that investment. You really want to just make sure you have a good time horizon and investing in a quality company or bond so that you know what you're getting into. And then another option is called a brokerage CD. Similarly to a retail bank CD, so it's a Capital One CD, these are going to be and a lot of these CDs will be still federally insured up to your amount of whatever it is. So the difference between these CDs and then a Capital One CD, for example, is these are called brokerage CDs, and usually you can get higher interest rates with them. But as with bonds, these are traded on the secondary market. So the values of the CD can fluctuate regardless of what you paid for it. So if you have to sell early, not only do you have to find a buyer for your bond, which is going to be a little bit harder than just exiting out of a Capital One CD, because Capital One is simply just you're transacting directly with Capital One. You have to find someone who is physically willing to actually buy your bonds or your CD. So similar to bonds, if interest rates are raised in the future, the older CDs will lose value. If you hold until the maturity of your CD, at the end of the day, you are technically okay. And usually brokered CDs are going to be a little safer than these corporate bonds, because if you can buy a brokered CD that is federally insured up to your principal, then really you're not at risk of losing any money as long as you hold it until maturity and you don't sell early and have to pay, potentially risk gaining or losing money based on if interest rates have fluctuated. So those are going to be the main options I think are going to be your best bets for money that you have a shorter time horizon. When I say shorter time horizon, I mean you're not investing for retirement, you're not investing for like 15, 20-year goals. These are going to be financial goals that you may have less than 10 years, specifically on usually going to be less than 5 years, but you can still get bonds that even go up 20 years or more. So you have options. And there's going to be money that you are wanting to grow at a higher rate than what a checking account or cash will offer you, which are going to be little to no growth, if at all. High yield savings are going to be the most liquid, easiest to move money in and out. I think this is going to be your best option for emergency funds, such as just saving money for a rainy day that might come up and you just need that money then and there. CDs are going to be great for if you know your time horizon, you're wanting to get a better interest rate than what a high yield savings will have, and you don't want to risk fluctuating that value in the secondary bond or brokerage market, as well as not wanting to really risk that money in the stock market. So I think this is going to be good for, let's say, you have a savings goal for a home and maybe you are set on saving for 2 years. I could do this 2-year CD for 4.1%. And things to keep in mind is that this is for if you have a lump sum of cash already, because you can't make monthly contributions to the CD. What you could potentially, or theoretically do, is save for a few months of a period of time in a 360 high yield savings account, and then use those savings to transfer into some sort of CD. And then I think these secondary market bonds and CDs are good for if you're someone who's willing to take a little bit more risk and you know that you're willing to do your homework on what the different bond options are or brokered CDs, and you are willing to hold through until maturity, regardless of if the value of the bond goes up or down. Because you remember, if you go onto your brokerage and you see that the value of your bond has decreased 50%, really you don't have to worry too much as long as you're not at risk of getting defaulted on your bond. Because if that bond value dropped, it could very well just be because newer bonds have higher interest rates, and that's okay. You just hold your bond until maturity. You just keep going. You keep on swimming. You make it until the end of that timeline, and you get your money back. You're good. You go home. Everything's fine. There is another option as well. It is called a Treasury I bond, and this is going to basically, it's an interest rate. It's a bond that pays you the rate of inflation. Historically, inflation is usually relatively low, and these bonds have not been, very high incentivizing to purchase, because this is a federal treasury bond that is going to basically just match the rate of inflation. As of right now, inflation's really high. And I actually have some Series I bonds myself, and when I bought them, I got them at 9.62%, significantly higher than, what these other fund options are. The problem with these is that absolutely no matter what, you cannot sell it before 1 year. They straight up will not let you. After 1 year, you will pay. There is technically no maturity date. Technically, the maturity date, I believe, is 30 years, but you're likely not going to be holding it for 30 years. You get your interest. Any interest that is paid out from this bond stays in the bond. If you want to learn more about this, you can go through treasurydirect.com and learn a little bit more about how this works. But basically, this interest rate is going to change every 6 months, and you're guaranteed this interest rate every time that rate changes. So I got in at 9.62%, and I'm getting my 9.62% for 6 months from the day I purchased it. After that 6 months ends, this is going to be the new rate. And that's still higher than some of my other options. And some of the pros and cons with this is historically, I bonds are usually pretty low interest rates, but as of right now, because of inflation, they're actually a pretty decent option. The cons is that you are limited to buy up to $10,000 per year, and you will have to pay you have to hold it for at least 1 year, and you will have to pay a 3-month interest fee, or if you pull out. It's going to be a little bit more difficult to pull money out. It's not going to take you like, because it's not like a Capital One account where it's might be linked directly within your bank. It's going to probably take a few days to actually get your money out of this. And there is no maturity date technically, so you are going to have to pay that 3 months penalty if you sell the bond within 5 years. After 5 years, if you hold it for 5 years, you're not going to be subject to that 3 month fee. And it's just things to keep in mind. So I think that hits the main options why I believe some might be better suited for others depending on your circumstances. I personally have the Series I. I maxed out the limit for this year because I got in at such a good interest rate. I also have money sitting in a 360 high yield savings, and I have a little bit set aside in an 18-month CD that I did with Capital One just to kind of set some money aside for higher interest rates that I know I'm not really going to need while I'm watching the stock market. I have a long-term time horizon for the majority of my money, so I'm kind of just sitting around watching the market, trying to find a good time to get in. And in the meantime, I'm doing my research on what actually I want to buy for my long-term time horizon goals. In the meantime, I'm still taking advantage of these short-term interest rates. So hope that made sense. Hope that you found this video useful and informative. Thank you guys for watching. If you have any feedback, feel free to leave it, like, comment, and subscribe. If you have any recommendations, feel free to let me know. I'd be more than happy to take a look. Thanks for watching. I really support the views. It helps encourage me to keep these videos rolling. Thanks for watching. Hope everyone has a great one. Peace out. See ya.